Welcome to this deep dive. Right now, global investors are being offered this total financial paradox.
Yeah, it really is an anomaly. I mean, the absolute safest place on earth to park your capital is somehow also the place paying you the highest returns.
Right, which completely breaks all the traditional rules of risk and reward. And those shifting mechanics are currently just tearing the euro apart.
They really are. It forces a total rewiring of how global portfolios are constructed. Because
Sure.
historically, you pay a premium for safety. You accept a lower yield because you're buying the security of a fortress.
Exactly, but today, the fortress is the one paying out a premium. And that dynamic is dictating the largest capital flows we see in the global system right now.
Exactly. It's a massive structural shift.
Which is exactly what we are mapping out for you today. We are stepping away from, the daily noise of market tickers to give you a high-level macro campaign briefing. Our mission today is a clash between two massive forces, the euro and the US dollar.
Yeah, the USD pair, the heavyweight fight.
It really is. We're going to map out the current macro regime, decode the incentive structures, track the liquidity positioning, map the risk scenarios, and then finally reveal the active campaign bias for the eurodollar.
And to really understand the trajectory of a currency pair that massive, you have to realize that daily price action is it's a lagging expression of underlying structural incentives.
It's like instead of watching the waves on the surface, which is what price action basically is, we're going to map the deep ocean currents that actually move the water.
I love that analogy. Because if you're zooming in on a 4-hour chart trying to interpret some random spike, you are missing the mechanics of the ocean.
Yeah.
Capital is ruthlessly rational. It flows where it is structurally rewarded, and it drains from where it's constrained.
So let's define the environment where those mechanics are actually operating, because to understand where capital is treated best, we first have to understand the current macro landscape.
Right, the current regime. And the big picture right now is that the global risk sentiment is a mix, but it's noticeably tilted toward caution.
Yeah, the baseline hum is definitely defensive.
Exactly. We see markets oscillating. One week you get a burst of aggressive risk-on behavior, and then the next week capital just retreats. But through it all, the U.S. dollar acts as this dual threat engine.
It's playing offense and defense simultaneously, because in a cautious environment, institutional capital naturally wants a safe haven, right?
Right. And the dollar, backed by the U.S. economy and the treasury market, is the ultimate global reserve asset. But the critical layer right now is the yield. You are getting paid a premium to hide in the absolute safest asset on the board.
And when you contrast that with the eurozone, the structural flaws become pretty glaring, because it's not just that Europe has weaker growth dynamics, though they do, it's that the eurozone isn't a monolithic economy.
No, not at all. It's a monetary union without a true fiscal union, which means it is burdened by intense internal fragmentation.
Okay, let's unpack this with an analogy. I like to picture the US as this fortified castle in a slightly gloomy medieval landscape. It has these massive high walls for safety, but it also has a full treasury paying out gold.
That's a great way to look at it.
And the eurozone, meanwhile, is like a property manager trying to fix the leaky plumbing in several different buildings all at once.
Yeah, and that leaky plumbing, that fragmentation, is the Achilles heel of the euro in this regime. Because look at the U.S. The Federal Reserve sets policy for a unified sovereign debt market. Whether you're in California or Texas, you're dealing with U.S. treasuries.
Right. It's all one system.
But the European Central Bank, the ECB, has to set a single monetary policy for a deeply fractured landscape. You have highly stable economies like Germany right next to heavily indebted ones like Italy.
So let's dig into the physical mechanism of that. Because if the ECB needs to aggressively fight inflation or defend its currency by keeping rates high, they can't just do that in a vacuum.
No, they have to worry about the sovereign spread. And the sovereign spread is everything for the ECB. If they push rates too high, the borrowing costs for a country like Italy skyrocket way faster than they do for Germany.
Ah, so the gap between the German Bund yield and the Italian BTP yield just blows out.
Exactly. If the ECB maintains a highly restrictive policy for too long, they literally risk triggering a sovereign debt crisis in southern Europe. The system breaks.
So the ECB has this structural ceiling on how aggressive they can be, whereas the Federal Reserve just doesn't have those same multi-sovereign constraints.
Precisely. The U.S. economy has proven resilient enough to absorb tighter policy, which allows the Fed to maintain higher rates for longer.
So the euro lacks the defensive appeal, and it's physically prevented from offering a competitive yield. Which brings us directly to the specific rules of the game, the incentive structure.
Right, and at the core of this macro campaign is the persistent rate differential. The Fed maintains a restrictive stance, offering higher policy rates in the ECB.
And this is where that castle dynamic doesn't just happen by accident. It's literally designed by policy.
Yeah, and what's fascinating here is the fundamental asymmetry. It's not just about what the central banks are doing, but what they can do. Like we said, the ECB faces structural constraints. The Fed doesn't.
Here's where it gets really interesting, though. I have to push back a little or just ask for clarification. Because if you look at the market right now, that rate differential isn't aggressively widening. It's wide, sure, but it's stable.
Right.
So a casual observer might look at that and think, well, the worst is priced in. The USD advantage is pausing. Why wouldn't the euro start creaking back up?
That is such a common misconception. The market doesn't need the spread to widen further. It just needs the spread to exist. Because the mathematics of a carry trade accrue daily.
It's like a tilted table, right? The table doesn't need to keep tilting further for the marbles to roll off. It just needs to stay tilted.
That's exactly it. If you're an institutional portfolio manager, mandated to hit a specific annual return, and you have a choice between a European sovereign bond yielding 2.5% or a U.S. Treasury yielding over 4%, you don't care if that gap is widening.
Right, you just care about the daily bleed.
Exactly. Every single day you hold the European paper, you are bleeding yield relative to your benchmark. It's the institutional mandates that drive this. It's not some speculative bet on what central banks will do next month.
It's just a legal requirement to hunt for yield right now. So if the table is tilted by these incentives, where are all the marbles, the capital actually gathering? Let's talk about liquidity positioning.
From a capital flow perspective, global capital is consistently gravitating toward U.S. assets, specifically treasuries and short-duration instruments that offer yield and incredible liquidity.
And how do U.S. markets actually absorb that massive volume without breaking? Because the yield is the magnet, but the market depth is what actually allows the capital to stay there.
Market depth is arguably as important as the yield itself. We aren't talking about retail day traders here. We are talking about sovereign wealth funds, central bank reserves, mega cap asset managers moving tens of billions of dollars.
I look at U.S. Treasuries in this environment almost like a financial black hole in a positive way regarding market mechanics. The sheer mass of the U.S. market depth combined with that high yield just strips liquidity away from smaller markets.
The gravity analogy is perfect. The U.S. Treasury market is the deepest, most liquid financial market in human history.
Yeah.
If a sovereign wealth fund needs to allocate $10 billion on a Tuesday afternoon, they can execute that in treasuries with minimal slippage.
It absorbs the volume without violently moving the price against them. But if they try to do that in Europe...
Oh, in Europe, the bond market is fractured.
Yeah.
You have French OATs, German bunds, Italian BTPs. If you dump $10 billion into one specific pocket of European sovereign debt, you're going to move the market price significantly.
So you suffer massive slippage.
Exactly. So for the largest pools of capital, the U.S. dollar offers the only plumbing system wide enough to handle their volume. And this emphasizes a crucial point. These are not short-term speculative day trades.
Right. These are persistent structural reallocations. Think about how you manage your own risk for a second. Do you put your money where it's complicated and fragmented, or where it's safe, simple, and pays you? That is exactly what global institutions are doing.
Precisely. A Japanese pension fund, structurally shifting its weighting out of European assets and into U.S. duration instruments, creates a steady, constant hum of demand for the dollar.
But look, no fortress is impenetrable. If all the capital in the world is piling into one side of the boat, we have to look at what could capsize it. Let's map out the risk scenarios.
Yeah. To invalidate this macro campaign, you need macro-level tectonic shifts. The first breakdown condition would be the Fed aggressively shifting into easing/slashing rates, while the ECB somehow remains restrictive.
Which would compress the rate differential in favor of the euro.
Right. The second scenario would be a structural improvement in eurozone growth. Not just a minor GDP beat, but a sustained economic boom that causes global capital to rotate back into European assets.
Like a European industrial renaissance, which doesn't seem likely tomorrow. And the third?
The third is a fully risk-on global environment. If all geopolitical tensions evaporated and global growth fired on all cylinders, demand for the USD as a safe haven would just plummet. Institutions would dump safe treasuries to chase high growth elsewhere.
Right.
This raises an important question, though. What should we actually monitor to ensure we don't get caught off guard? You look for structural shifts in policy or growth, not just an isolated data surprise.
So let me push back intellectually here. What is the most realistic Achilles heel? Is a sudden European growth miracle likely, or is the bigger risk a sudden Fed pivot?
Mathematically and historically, a domestic U.S. shock is the primary risk. A sudden, severe crack in the U.S. labor market. If unemployment spiked, the Fed's dual mandate would force them to abandon the inflation fight and aggressively cut rates.
And if they do that, that massive carry advantage vanishes overnight. Okay, so now that we know the regime, the incentives, the liquidity, and the risks, how do we actually execute? Let's reveal the campaign bias.
Based on the foundational architecture right now, the definitive campaign bias is clear. We are structurally short year USD fee. The campaign is active and fully intact.
Okay, so structurally short, but what is the actionable philosophy there?
The strategy is simple. You sell rallies. You do not chase weakness. Because this is a carry-driven campaign, it rewards discipline and time rather than razor-sharp precision.
And short-term price movements favoring the euro, like when it spikes upward on a random Tuesday, are often just temporary sentiment shifts or positioning adjustments, right? Like a short squeeze.
Exactly. Traders get nervous, they buy back their shorts to cover risk, and you get a mechanical spike. But nothing fundamental has changed. The ECB is still trapped, the Fed still offers a higher yield, and U.S. market depth is still unmatched.
So what does this all mean for you? When you see the euro spike up because of a sentiment blip, you don't panic and buy. You view it as a gift. It's a better entry point to build your short position.
Perfectly said. You ignore the noise and let the structural gravity of the dollar do the work.
Let's zoom back out and bring all of this together with our final probabilistic outlook based on everything we've unpacked today.
The core truth of the briefing is this. As long as yield, central bank policy asymmetry, and capital flows heavily favor the United States, the EUR-USD campaign remains structurally short. The probabilities favor continued dollar dominance.
We've established that the US dollar is benefiting from this incredible dual engine of high yield and safe haven status. But I want to leave you with a final thought to ponder on your own.
Oh, this is the big question.
It is. Historically, safe havens don't usually pay you the highest yield. So if you're a student of macro, ask yourself, what happens to the global financial system when the absolute safest place to put your money also happens to be the most lucrative?
Yeah.
At what point does that vacuum up so much global capital that the rest of the world's economy actually starts to bend under the pressure? Because gravity that strong eventually pulls everything in.
It's a fascinating structural risk to keep an eye on.
It really is. Thank you for joining us on this deep dive, and keep questioning the structural forces behind the headlines.